So everybody asks the same question, what's the best rate? But here's the problem, the best rate doesn't automatically mean the best deal, because mortgages are so much more than just a rate. They're a rate, they're a fee, sometimes a cashback, sometimes some other incentives. And depending on how it's structured, sometimes the cheapest looking rate can actually cost you more money. So today I'm going to do a proper deep dive with real numbers. First time buyers, purchasers and remortgages. And by the end of this, you should understand the numbers you really should be looking at. And it's not the rate. So let's imagine a typical first time buyer scenario. Purchase price $250,000, 10% deposit, mortgage $225,000, 25-year term, 2-year fixed rate deal. And let's compare some numbers. Option A, 4.5%, £999 product fee. And option B, 4.8% with no product fee. Well, a 4.5% on $225,000 over 25 years, roughly $1,250 a month. At 4.8%, around $1,290 a month. So the lower rate product saves you around £40 a month. Over 2 years, 40 times 24 is £960 saved. But the fee's £999. So over the fixed period, you've saved £960 but paid $999. So you're actually slightly worse off paying the fee. And then, of course, there's always the option of adding that fee to the mortgage. Most first-time buyers don't want to pay fees up front, so the $999 is going to get added to the loan. So that's a new loan of £225,999. And now you're paying interest on the fee. So over a 2-year fixed rate period, that could add another £80 to £100 of interest. So now that cheapest rate available has just cost you even more money. And here's the most important bit. The number you're actually comparing is not the rate, the fee, or even the monthly payment. It's the overall cost over the initial fixed period. That's the real comparison. Because lenders can structure the products in all kinds of different ways. Lower rate, higher fee, no fee, cashback, free legals, free valuations. So, for example, if a lender gives you a £500 cashback, that immediately affects your cost over the period. So a slightly higher rate could still work out cheaper with the cashback factored in. And this is why we don't do mortgages by rate. When we look at the results of a mortgage search, we're looking at it by total cost over initial period, because that's the number that really tells you what's going on. So if there's one takeaway from this I can give to first-time buyers, it's on smaller loan sizes, fee-paying deals often don't stack up. The rate saving's just not big enough to justify the fee. And if cash is tight, which it usually is when you're buying your first home, then keeping that £999 in your bank account can be a lot more valuable than saving £40 a month on the payment. The cheapest rate and the cheapest mortgage are not the same thing. It's like airline tickets. It looks cheap until you want to bring a suitcase. And if we start applying this to remortgage clients, then that's where things really scale up. Let's say there's an outstanding mortgage of $400,000, 25 years remaining, 2-year fix. Option A, 4.4%, £999 fee. Option B, 4.75%, no fee. So at 4.4%, that's a monthly payment of around £2,200. And at 4.75%, it's at around £2,285. So £85 different per month. Over 24 months, that's £85 times 24 equals £2,040 saved. Now, the fee was only £999. So you're about £1,041 better off over that fixed rate period. Completely different outcome to the first time buyer example. And if the fees added to the loan, well, $400,000 plus £999, the interest on that over 2 years is probably going to cost you an extra £90 to £110. So instead of saving £1,041, you're probably now at about $940. Still clearly better off. And this works for purchasers as well. The bigger the mortgage, the more powerful those small rate differences become. A 0.35% difference on a £400,000 mortgage is significant. On £150,000, not so much. Which is why blanket advice just doesn't work. You can't say fee deals are better or no fee deals are better. It depends on the loan size, the fixed period, whether you're thinking of moving again soon, whether you're going to overpay, whether you're paying the fee up front, any cashbacks that are included, free legals, all that sort of stuff. And most importantly, what is the total overall cost on the initial period? That's the number that matters. Not the headline rate, not the product fee, not the flashy cashback, all of it combined. So as I've said before, good brokers aren't just chasing rates. We model scenarios. What happens if we pay the fee? What happens if we add it? What happens if we fix for 5 years instead of 2? What happens if we move in 3 years? What happens if we move in 3 years when we've fixed it for 5? And sometimes the lowest rate does win. But sometimes it's a no-fee deal that wins. And sometimes the answer is just not obvious until you do the maths properly. For instance, if you wanted to do some eco upgrades on your home, there's special rates and special cashbacks to deal with that. Mortgages are so much more than headline rates. So if your fixed rate deal's ending in the next 6 to 12 months, if you're looking to purchase, if you're a first-time buyer, don't just chase a rate. Give me a call and let's run the numbers properly. Because doing it yourself does not guarantee you're going to get the best deal. And advice matters. I'm Patrick Weightman, your local East Midlands mortgage and protection advisor, serving clients up and down the UK. Links are in the bio. Speak to you soon. Bye-bye.